The content discussed in this podcast is for informational and educational purposes only and should not be construed as financial or mortgage advice. Always consult with a licensed professional before making any decisions regarding mortgages or financial matters.
Welcome to the Canadian Mortgage Show. Here are mortgage professionals Alex Pang and Alex Shanks to cut through the BS and educate Canadians on all things mortgages and real estate.
If someone gave me $300,000, but someone gave me access to that money and I didn't learn that, that could have been burnt instantly. And that's I feel like we probably need to control how the banks give people money, but they don't care. That's how they make their money.
Welcome to another episode of the Canadian Mortgage Show. This is episode 48. Alex Pang here alongside my co-host Alex Shanks. Alex, how's your summer been?
It's good, man. It's all busy. We've been in the trailer. We've been at lakes. We've been at anniversary parties. I think we've only had one weekend at home here, and that's all it looks like for the entire summer, which are all good things, but it's hectic.
Yeah, we've been busy ourselves this summer, but we're actually not going away this summer. It's mostly staying in town. We're going to two weddings this summer. We already went to one. My buddy Howard, who you saw about the gold electric motorcycle golf cart thing. We went to his wedding. It was great. And we have another one next week. And in between, my staycationing has been golf and pickleball.
Nice. I got out golfing once this year. I'm hoping to get out at least one more time. But it's just the days are busy doing stuff with the kids and the family, which are awesome. And then work is busy as well. And the nicest thing for you and me is we know that we can take work on the go, which is, it can be a blessing and a curse. That means the phone doesn't really shut down. I took last weekend off. I didn't have much service. So it was kind of nice to not have that phone. But when you come back, it's all right, here we go. Got to deal with everything now.
Yeah, exactly. Another thing that recently changed was I've decided to go back to the gym. I've had a home gym, and Alex has visited when he stayed over my place. There are limitations with the home gym. As we all know, the home gym was a huge craze because of COVID during, when we had lockdown. Remember that? That was 5 years ago, right? Didn't it feel like a weird dream did we live through that? And so the home gym was very convenient. It was great. Didn't have it to drive anywhere. Didn't have to pay a membership for anything. And it served its purpose for its time. But that feeling of I'm missing this, the leg press, the fly deck, the whole, the machines and everything. It started slowly creeping back, especially because I like working out in the morning and my wife is not working right now. And our guest room home gym is right beside our bedroom. And I don't want to wake up my wife. And, there's a few times I just took my bike out. Yeah. So, and then I'm like, man, this is not, this kind of sucks. So my son joined Planet Fitness and he told me about that. And, I checked it out and, I've joined Planet Fitness in Langley. So back in the gym. So,
do you know what Planet Fitness's business model is? Their business model is set up to just get mass amounts of people in there, and about 90% of the people actually don't show up. And that's where they build their spaces so it is almost tighter, and they make their costs super cheap, but they have people that will just keep paying and they never go to the gym. And it's
I think that's the case with most gyms. They know that, they'll have a huge influx of people, right? In January, for the New Year's resolutions, right? Probably the first 2 weeks is crazy busy. And then as soon as February hits, everyone forgets about it. They go back to regular life and it tails off. And that's how gyms make money, to be honest. That's all gyms in general. Yeah, actually, I used to be with Club 16 and they were pretty cheap. They were $15 a month in the beginning. But now they were $15 every 2 weeks. I'm like, no thanks. I decided to check out Club Planet Fitness and it was a little bit cheaper. So
you wouldn't like my gym cost then, Alex.
What are you paying Gold's Gym or whatever, like $100 a month, something?
More than that. It's I do CrossFit, so it's okay. $189 that way, but I used to go to the gym 7 days a week. I used to work out religiously, COVID hit, stopped doing it. Kids happen. I can't work out at home. Does not work for me. If I take a phone call, I'm done working out. And I like a little bit of competition. And that's where like CrossFit, like it brings some of that like good, heavy, hard workout. And it's 45 minutes. I go in at 9:15, I'm out at 10 and I'm like, I'm done for. Like I'm lying on the ground like, holy shit.
Yeah, it seems like you like the structure of going. If you were to do it on yourself, you probably wouldn't do it. And the biggest mistake you make is take a phone call when you're working out. So you need to learn there. I get phone calls when I'm working out. I'm like, nope, sorry, I'm working out. I'll talk to you later.
That's for CrossFit. I put the phone away. I don't see it. It's gone. Where like even if I went to the gym by myself now, I'd probably be like, oh, I got a phone call. I better take it. So it's CrossFit's what works for me. And yeah, but it's pricey.
Yeah, sounds good. I mean, I'm sure on top of your 189, you probably have a pool, a sauna, massage table, all those bells and whistles. No. I'm like, no thanks.
No, don't get any of that. I wish that is CrossFit gyms are like, I would say like probably again another good business model. Like it's cheaper than most gyms. Like you don't have there's no showers, there's none of that. It's you come in, you work out, and you leave.
Sounds good. All right, we have a lot to talk about on our agenda. We had 2 great guests the last few weeks, but the news items have piled up, so we need to get through it. So let's get into it, shall we?
Yeah, I mean we're gonna jump into the one, and it's I don't know. Did you get your video out today on social media, Alex? Today that's out on the news. The Bank of Canada did not cut interest rates, so you can clip that to put that on the news channel if you want. I've been telling people for the last like 2 weeks, I would bet $1 million that they weren't going to cut. Like that's how certain I was. The data told us. I kind of find it funny, Alex, you know, when we did the golf, like the tournament before, how I'm not going to say realtors, but they're like, oh, rates were meant to go down. Why aren't they going down? It's like the data has been telling us for the longest time, like they're not going down right now. Like it's clear as mud. I still find people are kind of shocked that they didn't cut here today. It kind of blows my mind a bit.
We've heard it even on the economic side too, amongst all the banks, all the economists, that we are showing signs of weakening, right? We're hearing unemployment is creeping up. There's weakness in the industries, but with the looming tariffs is actually inflationary, right? Because everything costs more. That actually causes inflation. And the Bank of Canada, their mandate is to bring inflation within their target, and their target is 1% to 2%. Is that the range we're talking about here?
Yeah,
inflation.
They want to be at 1 or 2%, and I mean we're kind of at that, but again, core inflation's a bit higher. Now, this was the fear when we started talking about tariffs of like we're gonna import inflation and everything. That's been the fear. Now, I can see 2 sides of it. Like at the same time, our inflation's also higher because of interest rate cost and rents. That has to do with interest rates. So like we're kind of a rock stuck in a hard place. Like we are going to get some inflation because of tariffs, but we also could potentially drop our inflation if rates were a tiny bit lower.
Yeah, it is very much like the dog chasing its tail kind of thing. And there's so much uncertainty when it comes to tariffs. I mean, they say that there's continuing talks, but all of a sudden, you know, we've been slapped with a 35% tariff on copper. And then I'm hearing this word that there might be a 50% tariff, but others news I'm hearing is that the tariffs are actually only going to affect 5% of industry. So, you know, but I think the fact remains that uncertainty is not good for the economy. Like whether it's a real thing or a perceived thing, it's the same thing when it comes to economics and markets and perception.
I could just go back to like, this is before the announcement when Mark Carney won and everything. Everyone was up in arms, obviously liberal conservatives. The thing that I was kind of excited about was certainty. I was like, hey, we're going to have some certainty. We're going to know where we're going. That's like, it's up in the air. For one, like the talk between Carney and Trump, they're pretty much over. We don't know if the tariffs are going to come in. We don't like it's again, we're just in that uncertain world. And like you said, Alex, that is not good for an economy. And I like to hear your thoughts. Like, do you think this is where rates should sit? Like, what's your thoughts on that? Like, where do you think like a healthy rate market is?
Yeah, I've long been saying that the healthy rate market was kind of before COVID. around the 3.5-4% range. We are a little bit above that. We're about 0.5% above that range. We're in about the 4 to 4.5% range right now. Earlier in the spring, there were rates in the high threes for that small period. I think it was maybe less than a month, right? I think it was probably like February, March, April, something like that, where there were some rates that was in the threes. But it wasn't a sweeping thing across the industry. And I kind of feel 3.5, 4 is kind of where we will be settling at. We have said before that rates are coming down, but it's not a straight line down. And it looks like when you go on those slides, when you go down and then there's like a bump, it's like it stays flat for a bit and then it goes down more. It feels like we're in that little flat phase where you're going to go down even more, but you don't know when. It's like, I don't know. How do you feel about that, Alex?
Yeah. And that's where if we went back to the start of the year we kind of talked about rates, like I see, like when we talk about rates, you have to remember there's different types of rates, like not talking about fixed and variable even. There's difference of putting less than 20% down and a 20% rate. There's even middle ground with insurable. So like, I believe a healthy market on the insured side was like 3.7, 3.8. We are close to that. There's some credit unions, some lenders can still get around there. The uninsured, that's where we're sitting a bit higher at like 4.34, 4.44, potentially rates going up. That's where I kind of believe where we is where I think we could be for the next 5 years. Like, and that's where it's the talk about variable to fixed now. Like it's changed for me of like, well, before, hey, you can take a variable and it worked for a little bit. I had clients that took a variable rate and we locked in 5 days after. They were able to lock in at a fixed rate of 3.84. If we would have taken the fixed rate, they would have been at 4.44. And so that strategy won then. Now I don't really know. It's a harder one to gauge. It's really trying to figure out what's your plans for the next 3 to 5 years. If there's at all a chance that you are going to be moving, you need to look at a variable or you could be hit with a big penalty.
Yeah. Put in a lot of clients in the last 6 months in variable because we've already, seen some fixed rates go up lately. Do you recommend people locking in now, or do you think maybe there might be more Bank of Canada cuts, which, I mean, it might indirectly affect bond yields. Do you think bond yields can come down a little bit more?
I think we'll see, like, again, they're kind of up, like they were up a little bit more 2 days ago. They're a tiny bit lower today. And that's just where I have had some people like, hey, let's see what it would be to lock in today. And that's where some people we have, but that was our entire plan. It was, hey, you're taking this variable at 4.5% because we know our risk is, hey, we either can lock into a fixed rate or, hey, if rates do drop, we're sitting extra pretty. And so some people are locking in. Again, it's a coin toss. I like to look at the risk reward. Hey, what if you lock in today? What could be your risk of that? What could be your reward? And it's like, hey, what if fixed rates are going to keep going up? Well, you'd rather lock in at 4% today than lock in 5 months at a 4.5%. And that's where we run the scenario of if it went down, this is what you're risking. If you lock in, this is what you're rewarding right now.
Yeah. I, when it went down a little bit, I kind of I hesitated to, like, I haven't contacted any of my clients about that. I'm actually banking on like a little bit more. And I still feel that there's another 0.5%, or at least, like, we know that there's maybe at least another one rate cut before the end of the year, maybe two, like maybe one before the end of the year and one early next year. I think I'm holding out a little bit longer before I advise clients to, hey, maybe consider locking again when you're hearing that banks are offering conventional mortgages in the threes again.
Yeah, that's the number. To me, it has to be if you can get the number under a 4%. I think that's where it's like, hey, it's time to look at it. If we're still sitting up over 4, I think there's room to play. The one for people that I think need to look at is people that are coming up for renewal at 1.5%. You might want to start looking at it sooner than 3 months. You might actually want to, like, hey, I maybe should get a rate hold today that's going to last for 3 months. My renewal might not be for 6 months, but what if your rate was actually higher in 3 months? You'd rather know today, hey, I have a rate secured. I get to watch it for the next 3 months, and you might break your mortgage earlier if the numbers actually work.
Yeah, yeah. It's right now. There's a lot of unpredictability right now. I mean, Alex and I can just talk about what we think, but we don't have crystal balls. Just like even Mark Altman said last week, we don't have a crystal ball. This is what we anticipate. The industry has been wrong before. We didn't predict 5% of rate increases in 18 months. As much as all our analysis and historical numbers have suggested, we were caught like with our pants down, like everyone. So,
the nice thing is we have that data now, and that's where like, hey, like for me, I do watch inflation, and like, yes, we're going to be importing it, but like if our numbers start going above 4.5% on an inflation, like for me, bells are going off. Like we have to think about anyone that's in a variable. It's like, hey, we have to be prepared to lock in way sooner. We didn't have that because yes, no one knew that inflation was going to go up as quickly. We didn't know that was going to be a war breaking out in the Ukraine. Like there were so many like factors that it never happened in history. We have that data now, and we get to use that, which is a nice thing that way.
Yeah, I think I'm more on the side of as soon as maybe we feel like this trade tariff war is going to end, or we sign an actual agreement with the US, then maybe that's when I'll start telling clients like, okay, maybe this is the bottom. Maybe we should lock in now. I might be wrong. That could be too late. But if I tell them to lock in now and we have a prolonged trade war for another year and rates go down another 0.5%, then I look like a fool. So we're stuck in a rock and a hard place as advisors.
That's where you get to say, hey, like your variable could be at 4.5% today. If you can get to a 3.99 today, well, even if they cut by 0.5%, you're winning right now. And that's where you have to run the risk reward there. And again, just so people know, when you get a fixed rate mortgage up front, the bank is adding a premium into it up front. They're adding for volatility because they have to hold that rate. When you go to lock in, they're looking at the bonds that day. And so like, that's where you can actually go and be like, hey, bonds are down today. I'm going to call my bank and see what I can lock in at. That's where like the hardest thing for me now is we can't do that for you. We're here to advise you, but we can't say, hey, you know what? I think this is what the rates are, because every bank's going to offer a little bit different based on where the bonds are.
You know, the big thing too is it's not just locking in. We're going to have that regular conversation of like you touched on earlier. Is your life going to change in the next couple of years? You're probably if you're going to move in the next couple of years, looking to upgrade or something, or downgrade or something like that, you might probably want to stay in variable, because the 3-month penalty is a lot less than, like 9 times more than that, or like, 15, 20 grand, so have those conversations before you lock in.
Yeah. And the other thing is like, is talking about porting. Everyone's like, hey, I'm going to port the mortgage. Now, when you're doing a conventional mortgage at a big bank, much easier. But if you have an insured mortgage and you're at like a monoline lender and you want to port it, it's going to depend. Are you going from a condo now to a house that has a septic system? That lender may say, no, I'm not doing it for you. And then when you talk about porting a variable rate mortgage, most lenders, you can't port a variable rate mortgage. It has to be a fixed rate. And so then you have to decide, well, do I lock in? Do I break it? The nice thing, there is a bid reg bank, Scotia, you can actually port their variable rate. And that's where it's explaining to people the pros and cons of each lender.
Absolutely. Absolutely. So, I mean, some, banks have upgraded their Bank of Canada rate forecasts. We did talk about it in previous pods that RBC has been the most, I guess, bearish or hawkish.
Well, I
guess hawkish.
I think it was Scotia before, actually. I think Scotia actually, like they were the ones that said rates could actually be a bit higher. They were not cutting. Like they used to be at 3% is what they said it was going to stay at. And then all the other banks were a little bit lower. And so that's where RBC is now just saying it's going to be flat. And if we looked at this, to me, I would say RBC or Scotia Bank is going to be the correct one. I don't believe like who's going down to 2%. You got National Bank saying that it's going to drop to 2%. I don't believe it.
Yeah. Like you're a little more conservative than I am. I'm probably on the side of the in between. So if you see this on the graph side, on the video side, it could, RBC saying that the cuts are done and we're going to be stuck at 2.75. That's the the key lending rate. Whereas BMO is a little more aggressive. They're saying it's going to cut another 3 times.
Yeah.
Now in between is Scotia, TD, National Bank, and CIBC. I'm kind of on the side of those 4 banks. Either 1 or 2 more cuts. I'm kind of more on that side, if you ask me.
Yeah, I would put on money on 1 cut, a 1.25. Like I could pretty much, to me, guarantee that. It's just, is it going to be more than that? Is it going to be at the end of 2025 or is it going to be at the start of 2026? I think that's really, really the data, and it's going to depend on the job reports. We will not be cutting until the US cuts now. Like that is guaranteed.
Yeah, that's what we alluded to earlier. Like, I think we've done enough cutting away from the States. The last couple of years, we cut more, and I guess the time was we were fearing that our dollar was going to hurt, but apparently our dollar has been okay, unbeknownst to all the economists and everything. And well, I mean, the reason why we cut faster than the States is we probably raised our rates faster than the States in the first place, right? So we're kind of returning to the historical trend where we are following in lockstep with the States. And now the States have said that, they are showing signs of weakness, but not enough to do anything yet, just like TIF and the Bank of Canada.
Trump comes in
and they start to... Exactly.
Unless he tries to fire Mr. Powell.
Yeah, but the same thing. Like the Fed and Bank of Canada is they're there. They operate independently out of any political influence, right?
And that's how it should be. And I mean, where Trump is coming in, and this is the same as where like Canada is. Like, we have to remember all the debt that we have. We're paying interest on that. Like, that's where Trudeau came up before. What are you talking about? We're paying interest at 1%. Our interest isn't at 1% anymore. And so like, that's where Trump is worried, is they're going to spend a bunch more money and their debt is just getting higher and higher. His way of trying to cut that would be, hey, cut interest rates by 300 basis points. I can now trim some of that debt off my books.
Yeah. I mean, other governments, what they did to offset the debt is to inflate their way out of the debt. Yeah. Like, make money so available that this $1 trillion isn't worth $1 trillion a day. The $1 trillion down the line is not worth as much. That's how some governments have done it. I don't know if that's the best idea.
No, and that's where like what people like debt, like inflation and debt can be a good thing. Like, it's a tool for people, but it has to be in the right thing. And that's an asset, a real estate asset. Inflation, that increases it. Like, if you have cash, if you had 100K cash and inflation is taking away from it, what the government does, your 100K is just getting less and less and less and less, where your asset is actually going up and your debt's going down on it. And that's where sometimes people, they're like, oh, well, I'm just going to hold the cash. And it's like, well, your cash is going to keep dropping and dropping and dropping.
Yeah. I mean, if you keep the cash, sure, the balance is going to stay the same. But because of inflation, the value of that cash can't buy you what it could, right? Yeah. We all know the whole like McDonald's. I'm dating myself, but a whole like an extra value deal used to cost me $5. This is like way back in high school. Now a meal is $15. Yeah, my goodness.
And I mean, I used to get like the Genoa salami at Subway, $5 foot long. Like, that's where I would go. And it's, I mean, a foot long at Subway, $16 now. Like, it's, and that's where we're talking to people about, they're trying to save money and they're like, where's my money going? Like, you look at what you're paying for food now and eating out. And I mean, if you were to cut some of that out, like, it's a massive amount of savings. Like, back when me and you were trying to buy out, like, we could cut some of that out, but it wasn't like so drastic. But like, someone now on average is spending like $2,000 to $3,000 on eating out. Like, that is a massive amount of money.
Yeah, no, I get you. There's been some graphs here that showing the national market in terms of real estate. Now it's showing here that BC is the only buyer's market in Canada based on the number of months of inventory. So I guess on this graph here, there's this purple line showing that between 4 to 5 months of inventory is considered balanced. And it looks like are kind of venturing into buyer's market territory, but relatively balanced. But BC here, we're at 6.5 months of inventory. We're clearly a buyer's market. And I definitely see it.
I'm surprised that Ontario is not higher, like just with the amount of stuff like they sell less. They're selling less than BC is.
Yeah, you know what? I bet you this graph does not account for pre-sales.
Yeah, that's
sales, right? Because they're not on the MLS and it's off market, but we know it's a shit show there right now, more so there than in BC. So that's probably not counted in the graph here. But it kind of goes back to saying we've been saying this, for months and months and months now, that it is a buyer's market. If you are in the market to buy, now's the time to buy. You can't time the market to the very bottom. You only know when the bottom is in retrospect, when there is an uptick in something. Now, I'm talking about stocks and investments too. You don't know, like anybody who says they can time the bottom, they were lucky, if anything. And you buy when the time is right for you. And so
that's where I mean, right now you get to look at properties. You get especially in Vancouver, I'll tell you this, had 3 clients a day, multiple offers where I live, going over asking super tight conditions. You can buy in Vancouver. You get the pick of your place. You get to have all your subjects. You get to pretty much buy it under asking. And that's where, if your numbers work today, it is an opportunity for some people. Now, I've run a couple things for people in Vancouver is they're renting for $1,100 a month in their parents' basement suite. There's no reason for them to get out. They're like, oh, maybe it's our time to buy. We crunch the numbers. Even if we factored in some appreciation and say, hey, you could buy, it is better for them to keep renting and putting their money away right now. And it will greatly outpace them trying to buy a place right now. And that's where you got to look at the numbers all together. Love owning a home. I love real estate, but it does not mean it's what's best for every person.
Yeah, exactly. So, I mean, there's no way that they'll continue paying $1,100, just by knowing the amount of real, especially in Greater Vancouver. I mean, they're going to go from 1,100 to easily 2 to 3 times that, whatever they're going to buy.
I had a call from someone in my town, and where we have a 1-bedroom suite and it's $1,650 for rent. Now there's a purpose-built rental, and the guy told me he's going to get a 2-bedroom for $1,100. I'm like, holy shit. That is crazy. And we helped him crunch numbers. He could buy a condo at $400,000. His monthly cost would be $1,800, or he could pay rent for $1,100. And that's where these purpose-built rentals, in some areas, they're going to bring the rental prices down 100%.
Yeah. And plus there's a lot of condo inventory in the market right now. The rents have been coming down, which is good for renters, not so good for sellers, but, that's kind of good for the market, to be honest with you.
It's, what do we got? Canada's housing starts held steady in June, up 0.4% from May. I mean, I feel like we're not built. All we're building at the moment is purpose-built rentals. That is the only thing that's being built. I saw a couple smaller time developers in Vancouver starting a new project. Same thing in Ontario. There is some people that are still trying to go in this market. I'm like, hey, hats off to you. Toronto fell 40% on weaker multi-unit activity. The problem is in those markets, the land value is just so expensive. And that's where I really believe these pre-sales that aren't going to start selling this is when the government's going to step in, and those are going to turn into rentals.
Yeah. I remember, when I was, earlier in the business, probably 12 years ago, something like that, where when sales dried up, a lot of developers have shifted to being purpose-built rentals. Now, I don't know if these high rises like Ani, Boza, and all that will convert 500 units to rentals. Maybe these smaller developers or these smaller projects, the low-rise ones, can do it if the numbers make sense for them. Rather than going bankrupt or whatever, to at least get some cash flow and turning into rental. I can definitely see a lot more of that happening.
Totally.
Yeah. We have a popular website called Wawa. Now, it's published in the Globe and Mail. the top performing investment of the 21st century. Now they've dated this back since 2001. The annual returns, gold is actually number one on that list at 10.3%. Now, coming in second, real estate with rent is 8.6% annual returns. Now we're looking at the other things. The markets, the S&P 500 in Canadian dollars, it's 8% appreciation, and the TSX at 7.3%. Now we also count real estate, holding real estate and not having rent is accumulated at 8%. What are your thoughts on that, Mr. Shanks?
Yeah, I mean, that's like, I'm guessing that's spread out all, like, that's across all of the US. Like, where's the real estate? Where's that coming from? Like, is that data coming from?
This is all Canada.
Yeah. Okay. That's all Canada that way. And so, yeah, I mean, it's again, we're taking the average where, I mean, we know like in some areas that like that number's drastically higher than 8.6, like we're talking much higher, but I think like, again, where one thing I find when people talk about investing, they're like, hey, you get a 10% average rate of return. That's if you spread out the time horizon over 100 years. It's easy to get a better average that way. But like where I find you need to take snapshot is looking at 2001 to now. Like, what is your return that way? We can't go back 100 years ago and say, hey, we were getting 10% back then or more. I like to look at it in like chunks of data that way.
Yeah. And then another thing for me too is why most people invest in real estate instead is we get leverage. Sure, like, on this graph here is the real estate is second, but you're getting 8.6% on let's say you're putting 20% down on a property. Let's say an example of you bought $1 million property, you put 200 grand down. You're getting 8.6% appreciation on the $1 million.
Yeah, let me
cash on cash. Yeah.
I'm looking at an investment property right now there, Alex, and we can talk about how I broke it down and how I look at the analysis. So the purchase price is $725. I think it's super undervalued. It has 3 rentals in it. The average sale price in that area is about $925,000. Like it's a foreclosure. It needs some paint. It needs some lipstick on it. The way that I look at it. So like with a 20% down payment, with closing costs, spending some money, I kind of need to spend about $200,000 on it. Now, what I've run is like a scenario of, hey, what if I invested $200,000 in the stock market and got a 6% rate of return? What I would get on my return for cash, like what you're talking about is your ROI. I would get about an 8 or 9% rate of return over like 3 to 5 years. What you're saying, if I buy it and I fix it up and I actually sell it in 2 or 3 years for say 925, my rate of return is 50%. And that is exactly like you said, the leverage on that amount is substantially higher. And that's where I find people don't crunch all those numbers. They just think, oh, I'm going to be in a safer investment. Real estate can be riskier, but so can stocks. Your return is greatly higher because you have that leverage.
So I did a number crunch, cash on cash. Okay. So 8.6% on, let's say the 1 million is 86,000. Okay. But you didn't put $1 million of your own money. You leveraged that. You really only put 200,000 minus all the soft costs, right? Let's say 200,000. 86,000 represents a 43% return on your cash. Yeah. So we're talking about cash on cash return. Real estate does trump it, right? Sorry if I used the wrong word, not trump, but whatever. Yes. So now I understand when you're investing in markets, you can also do margin. Like you can kind of borrow against it, but not at the same kind of leverage as real estate. You can't like, oh, I have 200 grand in investments. Doesn't mean I can buy $1 million worth of gold, right? Well, real estate affords you that.
You can get into option trading, and like, I don't even fully understand it, but I mean, that's where like the risk on that compared to a real estate investment, we're talking like 20 folds. Like you could invest 200,000 short of stock. And if that number does not go down like you think, I mean, you could be losing $1 million where you buy that $1 million property and hey, it doesn't really appreciate what you thought. You're losing $10,000, $20,000. You're not losing everything.
Yeah, and I find that most people they like real estate because it's an actual tangible asset. Um, it's something that people, will live in and take care of and occupy. So that's what they like versus, other things like stocks and investments. It's just a piece of paper. All it takes is some crazy CEO who owns Tesla to make, these weird comments or you're the CEO, you're the CEO of Astronomer and you go to Coldplay with your side piece and you get caught and all of a sudden it blows up. There goes your company and there goes your investment in that company. So all it takes for that. Whereas real estate it's like a big cruise ship. It takes a lot of energy to move. Yes, it can go crazy, but for the most part, we don't see crazy like crashes like you do in the stock market. I mean, we're experiencing a slow correction and prices have gone down 15%, but it's taken 3 years for that to happen. And it might be slowing down or who knows. But yeah, if it's, what is that saying? I think is it Theodore Roosevelt said that, or I don't remember the saying is that real estate, when done properly and managed properly, is the safest investment in the world. And you can fact check that, guys. I'll look it up and see who quoted that.
Yeah. And that's where it's the nicest thing that I think what's happening with real estate and where it should be is you can't just buy something and it just appreciate for 100,000 for doing nothing. It's like, hey, you have to buy the asset and you actually have to do stuff to it. You need to buy a property that needs some work. Maybe there's no rental suites in it and like you're fixing it up. Like real estate, like that is where true real estate investing is, not just like we talk about speculation.
All right. So we move on.
Let's talk about this one. The 35 to 40-year-olds that are the most indebted in Canadians. Like, holy smokes. I'll briefly just talk about this. Like, there was an article that came out, like Canadians are spending 43% of their income on taxes. That is the average amount of money we're spending on our taxes. And hey, I'm fine with taxes. Like if I know where it's going, what we're using it for, I feel like we've talked about this before. Our money is just gone and it's not doing what it used to do. Our roads are not getting fixed properly. Our hospitals are not actually running as well as they used to be. And it's pretty crazy the amount of people have to pay in taxes. And the reason why people are taking on debt is because they don't have the same amount of money as they used to have.
Yeah. Yeah. And you know what? I can, I'm not too far away from this cohort from 35 to 44. I'm 47 if you guys are.
I'm on with it. And I'm not even in the 35 to 44.
Yeah. Like maybe from just thinking about your life, this age group is kind of like you probably be hitting your peak earning potential. Hope so. And yeah, oftentimes we end up spending what we make or our lifestyle goes up to what we make. Yes, we may be making more money, but we also end up spending more money because of it. Like, oh, now that I'm earning more at my job, I got promoted to manager, I'm moving on up. Now I can buy a nicer place and I need to have a nicer car to fit that lifestyle. And of course, that's why we are more in debt, right? Like, I've had clients who are, like doctors, they make a ton of money, but they're probably up to their noses in debt. Yeah. And you would think that they are like, well off. Some are if they're financially astute and they manage their finances properly and they have the right people on their team. But others, they could be just as financially illiterate as others. And they're like, oh, hey, I'm making bank now. I'm driving a Lambo. I have all these boats and they're freaking, up to the eyeballs in debt.
Yeah.
So
again, they're looking at the monthly payments. And this is, I've talked to like doctors, especially like doctors. If you were a doctor, the banks will give you everything. Like as soon as someone's in school, they're 21, they're 22. The banks will go into those universities and stuff to those programs and say, hey, here's a $300,000 line of credit. No questions asked. They'll give it to you. And if you are not financial savvy, I've heard the dentist industry has the biggest like bankruptcy, like more of them claim bankruptcy because that they've been giving access to these massive line of credits at 21. If someone gave me $300,000 I was financial savvy at about like 18, stopped spending money, but someone gave me access to that money and I didn't learn that. I mean, that could have been burnt instantly. And that's like, I feel like we probably need to control how the banks give people money, but they don't care. That's how they make their money.
Yeah. And then they do that for doctors because they have crazy earning potential. And doctors are seen as the bank's unicorn client, like their favorite, because they can get their business accounts, they can have high earning potential. They want to start off their own practice. You can give them a commercial loan, business bank accounts, everything, and all their investments. They can sink their claws into the doctors and dentists and such. So I can see that, but that kind of goes to show that honestly, the banks are not on your side. They're there to make money. They're there for what you need them to, and for folks, have an independent advisor. You want an independent mortgage broker on your side. Same thing when it comes to financial advisor. Like if you are dealing with somebody at the bank, they're honestly not really serving you. They're really there just to sell you stuff. Have an independent professional who's not working for the bank, but have access to many institutions, many products, anything. So their fiduciary duty is to serve you. So seek someone that's independent.
I had that conversation today with someone. They're trying to figure out, should they take a HELOC? Should they take a mortgage? The bank hasn't sent them any documents, haven't helped them plan, like, hey, should you actually buy an investment property? And I just explained to them, like, the banks do not have a fiduciary duty to you. Me and Alex, like, we have a fiduciary duty to you. If we do something to harm you and you find out, hey, Alex took me to this lender because he gets paid more, didn't actually do what was right for me, you could come and sue us. Like, that's like legally what you get to do. At the banks, there is no ramifications there. They could mess up everything, and all they're going to say is, hey, we didn't train that person properly. Sorry, you're on your own.
Yeah, exactly. All right, we move on. Okay, so you know what? More bad news in the real estate industry. New construction home sales are tanking. I mean, surprise, surprise. We already kind of knew that. They're running as low as 86 below the last 4-year average from 2020 to 2024. So, this kind of goes on without saying, construction boom is over. You will see the graph here. I mean, most of the negative action is in the GTA area, Toronto and the Golden Horseshoe, Hamilton, Kitchener, Waterloo, Toronto. It's minus 80% and more. Vancouver, we're down more than 50%, still bad too, but yeah, Toronto's really suffering right now.
And then I want to kind of go over this, like the new Mortgage Professionals Canada survey. I think this is super cool seeing. Not this, 7 in 10 need help with family for their down payment, which again, we're just seeing more and more, especially in like the bigger markets, Vancouver and Toronto. Average down payment coming from families like 100,000. Like that's just the average number. Where I'm at, it's more like we see 20,000, 30,000. But it's just such a more of a normal thing now. This is a really cool 81% who used a broker would do it again. Versus 58% with the banks. Now, some people just have that tie with their bank. They feel comfortable with them. And like, I understand, like the banks have been around forever. And that's why there's the allure of them. Like, hey, these people are there. They're there for us. But like I said, you want to understand what is a fiduciary duty. And so the market share right now, there's only 32% of people actually use mortgage brokers. Like there's still such a massive market share out there. But it's saying 68% plan to next time. Yeah.
44% think now is a good time to buy in the community, which is great. And 35%, this is a sad one, 35% of non-owners say they will never be able to buy a home, which is kind of sad. But it is kind of the par for the course in the industry right now with unaffordability. But I want to circle back to the stat saying that brokers are 81% who used it would do it again. You know what, Alex? Give yourself a pat on the back for all the work that we've done to just to advise, to have this pod, to cut out the BS, to cut through all the talk here, and just keeping it real for the general public there. But yeah, that's just kind of how it is in our mortgage market. This last item before we go here, BMO does see a prolonged bear market ahead for Canadian housing. We were talking about it last week with Mark too. Are we going to see a bear market for 5 years? it's hard to say, like even when you talk to every single bank economist, we get so many different projections and stuff. So by them saying prolonged, I mean, like, hey, Bank of Canada, Tiff said rates were going to be low for a long time. And guess what? That only lasted 2 years. So I don't know. Do you agree with them?
I think it depends on the area. Like I think like right now it's even like stocks. Like no one thought the stock market was going to be doing what it's doing right now. And like, that's where you could say the stocks are a nice place right now because of the uncertainty. Like that brings good gains over there. Real estate, like it's just an uncertain time right now. I would say different areas. Like if you were telling me, hey, should I go buy a condo in Vancouver as investment? I'm probably going to say no. If you're going to buy a house like on Vancouver Island, and hold it, I probably would say yes. Like it's every market's going to be different.
Yeah, sounds good. I mean, we got a whole lot more to talk about, but this will end up being a 2-hour show, and I don't think our audience is going to want that. So, any closing thoughts? I think you're going away this weekend, aren't you?
Just going to a lake, going in our trailer stuff. Got some longtime friends from Vancouver coming over. We're gonna hang out, do some wakeboarding. My knee, for everyone, it's doing better. I could barely walk for a bit, but I can bend it. I think I'll be able to wake surf this weekend, though. There might not be any more wakeboarding this year. That might be a next year thing.
The problems of being 6'7", not having and not having the best, the balance or the what's that center of gravity? I guess.
It's not even that. I mean, it's just it was I think just a freak accident in knees, and I mean, honestly, my knees are, even though I'm 6'7", are probably better than most other people's knees. Like I know so many friends that they're crippled from sports and everything. I had one knee that I hurt from football. Everything else, like, it's pretty good, but I hurt my knee, and then it was at the gym. I pulled my shoulder. I'm like, oh shit, I'm over 30 now. It is starting to hit me.
Something I've taken up. I don't do it that frequently, but on occasion, do yoga. It's not like I take a yoga class or anything. I look it up on YouTube and I just do it at home and do some stretching. I'm like, I used to make fun of these people back in the day because I'm more of a sports guy. I'm more of into competition and all that stuff. But man, it's challenging, especially as men. We're not flexible by nature compared to women. And, women can do these crazy poses like the downward dog and all these, whatever. And when I do it, I'm like, oh my gosh, I'm struggling. But it's amazing just as people to stretch and to stay limber and stuff to avoid injury.
Yeah, I should do it more. It's honestly, I just get bored. I can't sit in the same pose for that long. It more comes down to ADHD. I can't sit there.
Sounds good. All right, folks. Thanks for tuning in. Again, please like, follow, and subscribe. If you like this episode, please share it with a friend, family member, and someone else who you think would benefit from listening to our pod. So on behalf of Alex Shanks, I'm Alex Pang. Thanks for tuning in to episode 48. We are closing in on 1 year anniversary, and we are glad you are here with us. We'll see you next time.
Talk to you later. Now, if you enjoyed this episode, make sure to like and subscribe. If you're listening on Spotify or Apple, make sure to follow us. Please give us a 5-star rating. You can even send us an email because we want to know what you guys want to hear about. That's what we're here for. Reach out anytime.